Hi, this is Karen Lin. This is the third video of week 4 about chapter 5, closing process. In the past chapters, we discussed basically everything but the closing process of an accounting cycle. We talk about how we identify transactions and analyze how the transactions affect our debit and credit of our accounting equation. We will record the transactions using something called the journal entry, which is basically debit something, credit something, and they have to be in the same amount. We post these journal entries to a general ledger so that we summarize all these different, or we sorting all these different data into different accounts. And we prepare an unadjusted trial balance after we post those journal entries because we want to make sure we are doing things correctly. And then what we talked about in chapter 4 is that we adjust we adjust the financial status that we have already been recorded and find out, I'm going to say that again. We are going to review all the data we have entered, and we are going to find out things that are not reasonable to us, mainly are related to revenue expenses recognition by reviewing all the past transactions. And then we do another adjusted trial balance, so we can figure out whether we have done things correctly and we adjust them and whether we post them correctly. So if the debit side and credit side of the trial balance are equal, we are basically all set. And then we will prepare financial statement based on the adjusted trial balance. We prepare the income statement, statement retained earnings, and the balance sheet. Okay, the last step of this cycle is to close the books. I'm going to talk about what that means, but this is the end of the accounting cycle. So this is the end of the month or the quarter or the year, whichever accounting period your company has picked. And the next month we start all over again. Okay, so when we talk about cycle, it is a circle that goes again and again each period. So when we talk about the closing process, we need to talk about uh, two different types of accounts. So we have different uh, categories for our accounts. Basically, we have assets, liabilities, and stockholders' equity. We have revenues, expenses, and dividend. So I want to introduce to you that some of these accounts called permanent account, which means these accounts are not closed and they accumulate numbers period by period. The other type of account called temporary account. Those are revenue, expenses, and dividend account, which means these accounts are closed at the end of the period. And what close mean is that we are resetting these accounts. So a simple way to express this is that if you think about revenues, we are always evaluating a manager's performance during the period. So after this period, we are going to set the manager's performance to 0 again, and then we will start reviewing their performance next cycle. So all these revenues, expenses, and dividend that we pay to the investors, we don't want them to be accumulated because we want to figure out quickly how much we have been paid during a certain period, and so on and so forth. How much the manager has been earned in the period, right? But for all the asset accounts, for example, cash, we don't need to know how much cash we have earned this period. I mean, we do, but in a nutshell, what investors are more interested or very interested is how much cash that the company has at this point of the year or the date that you end your accounting period. How much cash do you have all along the history? So all these asset accounts will accumulate and carry over the balances across period. They are never reset to zero, whereas the revenue accounts, expenses accounts, and dividend accounts, they are reset every single period, if that makes sense to you. Why do we close accounts? It's because the temporary accounts, they contain ending balance only for a specific period, and we are close them to prepare for our next periods. So they are giving zero balances, and so that the next accounting period, we start those accounts all over again. So what are the accounts to close? As we said, all temporary accounts are to be closed. Those are all accounts in the income statement that, so in our course, it's the revenues and expenses. All drawing accounts in our example, in our course, it is the dividend account. Okay, and we have something called the income summary, which is the intermediate or intermediate step to get our accounts to close. This account needs to be closed as well. So I'm going to show you how it works. Here is how it works. We have all the revenue accounts and expenses account at the end of the period. So revenue accounts normally have a credit balance, right? How to make that go to zero? You would debit the same amount as the balance shows, that then it will cancel out on both sides. It goes to zero. So let's say you have a credit balance of revenues for $100 sitting in your general ledger. You would debit $100 to revenues and you credit that same amount to income summary. Similarly, you would credit whatever expenses balance you have at the end of the day, debit that amount to income summary. Now you can see income summary is basically the net income, because that's revenue minus expenses. We have to close that as well, as I said in the previous slides. So income summary normally would have a credit balance because it's a net income. We would debit that balance and close that to retained earnings. Dividends will be close to retained earnings as well, but it does not flow through the income summary. Okay, now I'm going to show you how it works. Let's say you have revenues $100, expenses $40 of your company, and the company paid $10 dividend during the period. Okay, this is the end of the month. We are trying to close all these temporary accounts, which means we want to make them to zero. We want to reset the accounts basically. So I'm going to make, if I'm trying to make this 100 go to zero, I'll debit 100 and credit the same amount, right? You debit revenue, you credit income summary, $100. Similarly, you credit expenses, $40, you debit income summary, $40, right? Same amount. So you will see revenue goes to zero, expenses go to zero. Income summary, you have the credit side, you have the debit side. When they net, it becomes 60. This is exactly what your income statement should show as the net income, of course, before taxes and everything. If your taxes, expenses, yeah, let me take it back. So this is the income summary. If your tax expenses is already in all the expenses, the income summary is the net income that your income statement will show. So your net income is basically $60. I need to close income summary account as well. So I'm going to debit the 60 income summary. I'm going to credit retained earnings. Okay, I'm going to credit retained earnings. By doing so, I'm basically closing my income summary. So my income summary is actually zero. Okay. Now my dividend account. Dividend account does not flow through income summary. Again, because income summary is net income, dividend does not belong to the management generated resources and during the period. It is a withdrawal account. It's a payback of capital to the investors. So it does not flow through net income. we are going to credit the dividend. We're going to debit retained earnings. So what is my ending balance of retained earnings? That is 50, given that I don't have any beginning balance of retained earnings. Okay? If I have any beginning balance, that the beginning balance would be added up to the $50. All right, so so this is how we do the closing. After closing, all my temporary accounts become 0, okay, and dividend account becomes 0 as well. Now you can go back connecting the dots. If you think about chapter 1 and 2, we talk about retained earnings. What does that mean? It means the management generated resources and kept in the firm, right? So that is the management generated resources, which is the revenue that would increase my retained earnings. The expenses that we incurred to generate the revenue would decrease my retained earnings, right? So let's say if my retained earnings at the beginning 0, okay? So it would be increasing with revenue by 100. It would be decreasing by expenses 40, right? Remember? And also, this is the management generated resources, basically. This is the management generated revenue. This is the resources expend to generate the revenue. So this is basically the management generated resources. And the dividend also decreasing my retained earnings because it is a withdrawal of basically the capital for the investors. So it is their return of their capital. Okay, so this would also reduce our retained earnings. This is basically the part that is not kept in the firm. So if we have the management generated resources excluding the part that's not kept in the firm, the remaining part is the management generated resources that's kept in the firm. So that means retained earnings at the end. Okay, ending balance. Okay, so now you see that the dots can be connected. Our retained earnings is basically the account that connects our temporary account and our permanent account. Okay, I'm going to show you going back to what we have done. We have seen all these temporary accounts. They are basically connected with the permanent account by the retained earnings account in the stockholders' equity category. So all our revenues, expenses, and dividends are closed to the revenue account, to the retained earnings account, and the retained earnings account basically carry over all the performance that the manager made during the past, excluding the capital return, which is the dividend, to the investors. Okay, so this is the part that connects the temporary accounts and the permanent account, which means when we reset these accounts to 0, we are not just wiped it out. They are carried over in the retained earnings account. They are not wiped out by nothing. All right. So formally, what we do is that in the case we just seen in the last chapter, we have adjusted all these accounts to their reasonable balances. We look for all the revenues that we need to close. Okay. When you look for revenues, do not use unearned revenues because they start with 2. That's a liability account. So revenues are the 4s. Okay. Fees, revenue, interest, revenue. So we debit those revenue accounts, we credit income summary for these two added up. So when you have a debit, you have a credit, and they must be the same amount. For all the expenses, we look at our trial balances. We look at all the accounts that start with 5, right? Those are my expenses account. Now you can see prepaid expense are not among the expenses. So I'm going to debit income summary. I'm going to credit all these expenses accounts. That makes all those expenses account go to 0. And I'm also closing those to my income summary. Finally, I'm closing income summary to retained earnings. I'm debiting the income summary. I'm crediting retained earnings. Also, I'm debiting retained earnings, crediting dividends. Again, dividends does not flow through income summary to retained earnings. It flowed to retained earnings directly. Okay, so that is the closing process, and that is the end of the accounting cycle. So this is the end of this video. If you have any questions, you're welcome to email me or bring that up in the chat. Thank you.